Alibaba is cutting 1/3 of their deal staff. And so the question is, how does that impact the company's valuation? Well, that's what we're going to talk about in this video. So guys, smash that like button, subscribe if you're new, and of course, leave a meow in the chat. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. Now, this is not the first time that we heard about layoffs being announced at Alibaba or other tech firms in general. But this one's an interesting one because it's very specifically tied to their deals team. And so that's what I want to get into. So you can see here, as reported by Reuters, Alibaba has already cut 1/3 of its deal team staff after a regulatory crackdown. And what do they mean by that? Well, it means that Alibaba is cutting over 1/3 of its staff, or has already cut 1/3 of its staff in its in-house deals team, which was reported to by 4 people with knowledge of the matter. Now, like I always say, I don't like unnamed sources, but if they're going to say multiple sources, then I'll say that multiple sources does provide more credibility to an article that's citing unnamed sources. Now, Alibaba plans to reduce its strategic team of more than 110 people, mainly based in China, to around 70 people. Now, here's why I say that I believe that they've already done it. The company has already informed a bulk of staffers of their redundancy. And so I think it's just more going through the formal process of letting them go, but it looks like they've already been identified. And this is what I mean about this is not the first time Alibaba was named in an article that discussed the potential for job cuts. Remember in March that Alibaba and Tencent was reported by Reuters stating that they're readying to have big job cuts. And what do they mean by that? Well, you can see that while Alibaba didn't actually announce specific targets, Reuters was reporting that they could ultimately axe more than 15% of its total workforce, or about 39,000 staff. And the reason why they're doing that is because, of course, there's a regulatory crackdown coupled with a slowing economy, which has sharply slowed sales growth for most of the internet companies in China. And of course, not just the internet companies in China, North American internet companies are also feeling slower sort of revenue growth as well. And what's interesting about the deals team at Alibaba is, note this sentence here where they said that Alibaba has attracted talents from major Wall Street banks and private equity funds, including veteran Goldman Sachs dealmaker Michael Evans, over the years to strengthen its in-house deal-making capabilities. So effectively what they're saying is there's some real heavy hitters that are on the chopping block potentially in this environment. And what exactly has this deal team done? Well, you can see here from 2015 to 2021, Alibaba on average made 44 investments every year. And they peaked in 2018 with around 70 deals totaling $54 billion. Even in 2021, amidst the sort of like regulatory crackdown, Alibaba cut 38 deals totaling $6.2 billion. And in 2022, they still made quite a bit of investments. They cut 9 deals worth $5.2 billion. And so the question is, what exactly does this mean for the overall valuation of Alibaba? Well, I just think that the whole reason why the deals team is there is to allocate their excess capital. And so if they're not allocating excess capital, I just think that that capital in this environment just gets used to buy back more shares. So as investors of Alibaba, I don't think we experience a huge loss. The only thing we might lose is sort of like opportunity cost, where they might be able to invest in a company that would have pushed the bottom line up faster than the value that we get through share buybacks. But ultimately, it doesn't really impact my value. You can see here that despite the midterm challenges, there seems to still be considerable value here based on the current share price relative to the company's intrinsic value. And so obviously my intrinsic value that I'm allocating to Alibaba is $300 per share. And so this could be a 2x type investment. And it's been like that for a long time now. It just sort of goes up and down. Largely investing in Alibaba has really become an abusive relationship, but like I always say, you always have to focus on diversification, and that's exactly what I sort of stress on this channel. And what do I mean by diversification? Well, you can see here that with every market challenge there are opportunities, which is what I'm attempting to uncover and make available to the Patreons. And so one of the ways that you can diversify away from Alibaba and not have your whole portfolio concentrated in China is by looking at sort of the tracker that the Patreons get access to. Currently, there are 9 companies trading at a value that's less than 50% of their intrinsic value, and the list is growing each week as the market continues to decline. I uncovered a couple of them here. You got Foot Locker and you got Alphabet, but there's quite a bit of other opportunities available as well. And how do you get access to those sort of opportunities? Well, you can get access to the tracker that all of the Patreons get access to at the lower tier of the Patreon membership level. And if you want to join us for an epic live presentation each month, which is a live Zoom call, I actually save my best research for that call. And so you can join us live every month. And I did show you uncovered in that tracker an opportunity for Foot Locker, which is a very interesting way to diversify. And I actually dived deep into sort of that opportunity in this video, which you can get access to right here.